I'm here today with one of our trusted lenders, Amy Oler of the Big Life Home Loan Group. And she's here to answer some questions that we have about how the home loan process has changed here in this quarantine 2020 time, because there's a lot out there on Facebook and different things that people are saying, and honestly not all of it is completely right. So I wanted to get a word from someone who does a lot of these home loans on really what's changed. And Amy, thanks for joining us. Can you tell us like what's changed in this time?
What's most important during this time is communication and having a plan B option.
Mm-hmm.
And what I mean by that is a lot of clients, for instance, may only qualify one particular way. And so we kind of warn those individuals that, especially if they're kind of on the border with their credit scores or debt to income ratio, that we have to have plan B options. Because it is true, nearly daily, we do get slight revisions in what's going on in our industry. The first thing that really kind of fell off were what were called non-QM loans, which was non-qualified mortgages. Basically, these are individuals that maybe have the necessity to put smaller down payments on jumbo or even super jumbo products, or they need bank statement programs because maybe they don't document or report all their income. So these non-QM products were the first to kind of be, they were suspended.
Okay.
It's been about 3 weeks ago. That impacted quite a bit of people in the industry, or in the market rather, because when these were suspended, that meant that even if you were in the pipe and you were about to close, there was funding for you.
Oh, wow. Okay.
So that was pretty scary because we didn't think that everything would roll out so quickly. We didn't think the changes would happen this quickly.
I see.
Well, that kind of rolled into, all right, no longer will 580 be the minimum credit score for government loans. Immediately went up to 620.
Oh, wow. That's a big jump.
Down payment assistance programs went from 620 to 640. Of course, when I'm saying this, there is always somebody out there doing them at a very high premium. They are probably going to be a portfolio lender or an individual private investors, but most lenders that are getting insured by Fannie or Freddie or FHA, VA, USDA, we kind of had to tighten our guidelines because we don't know by the time we close, those loans will be sellable, because we want to make certain that we are creating programs, loans that are going to produce, that are going to make, people are going to make their payments. There's not going to be a default.
Let me ask this. You said so certain loan programs, the credit qualifications have gone up by maybe 20 to 40 points. If someone was pre-approved on a loan already, they were under contract, the process has started, and then something like this goes into effect, say 2 weeks from the close, does that mean they then may not qualify on the close, even though originally they were approved on that?
No, most of us are allowing those loans to be grandfathered in.
Oh, got it.
But what's happening is we got to be very careful. If we've pre-qualified someone prior to going and writing an offer, we're having to stop, look at our pipeline, pull reports. Do I have someone that's got a 580 credit score that thinks they qualify and they're out there shopping? So we're having to go through our database and make certain that those pre-qualified borrowers still qualify in our current pandemic situation.
I see.
The other thing is this week alone, most lenders have suspended all manual underwriting, which means that when we get a loan and we get the application and the income and asset documentation, we have to run loans through an automated approval system. Conventional products are typically ran through what's called DU, that's Fannie Mae's direct underwriting. And then LP, Loan Prospector, or LPA, those are Freddie's tools. And this week, Fannie Mae and Freddie Mac tightened their automated approval system. So for instance, whereas if you even had a 660 score last week and your debt to income ratio might have been 47%, this week we may not get the same approval. They may have gone in there and tightened it where you've got to be at a 45% debt to income or less.
Oh, got it.
So lenders have to, more than ever, stay current on all agency changes, because different agencies, being Fannie Mae, Freddie Mac, USDA, VA, FHA, these are agencies. Their guidelines are changing constantly. And so if you're not kind of in the know and following up daily, you're going to be giving this information.
Yeah.
And I'll be honest, I mean, I've been in the industry 30 years, and a loan officer can kind of look at a file and get a good feeling.
Sure.
We don't get good feelings anymore. You just can't, because you'll have a file and you're like, oh my gosh, I cannot believe it's a 680 credit score. It's this, that. Why am I not getting an automated approval?
Yeah.
The other thing I'd like to add is that as lenders, as it's gotten easy to do mortgage loans and easy to qualify people, a lot of lenders have gotten kind of relaxed where they don't ask for everything up front. They feel like they don't want to inconvenience the borrower. Joe Bob's got great credit. He's been with his employer a long time. He's a salaried person. What could go wrong? And so they would just ask for, just give me your pay stubs and we'll be good to go.
Yeah.
Honestly, since I've been in the business so long, I've never resorted back to that. I always ask for everything up front, including additional assets that people aren't even going to use, because we found, even since 07 and 08, if we're just able to document a little bit more in terms of assets in the application itself, it's amazing that $1,000 or $3,000 extra in maybe a retirement account that they haven't looked at in 10 years will give us an approval versus if you didn't have that many. So the systems are very sensitive. So I would say that right now as a lender, we're very much wanting to make certain that we have as much information on the file as possible, that we are running the automated approvals before the underwriter does, which again, these are all things that my team and I have done forever, but I know there's a lot of lenders out there that don't. So it's very important to run your automated findings. Some loan officers wait until the processor gets the file in order to do that. But my goodness, you could be working with the clients for months before it gets in front of a processor.
Yeah, so something interesting that you mentioned, you said that the amount of assets in terms of like cash and in an account, that actually makes a difference. I never even knew that. I thought it was always about income, and then the debt to income ratio, and then just enough money for down payment. So you're saying if people actually have more cash in their accounts behind, that can make the difference in approval?
Oh, absolutely. It always has been that way.
Yeah.
It's more important now than ever because the agencies guidelines have changed, where if someone has a credit score that is 620, we have to make sure that they have some reserves. We have to make sure that people, if their hours get cut, if they get furloughed, like there's a reserve, there's money. They're using their last dime to purchase this house. Now, we've always thought like that, truly, but it's even more important now. Another thing that's been quite different is the verification of employment. I just mentioned a lot of people getting furloughed or their hours cut. So traditionally, we would verify employment to make sure we have a pre-approved file. And then maybe 10 days before closing, we would re-verify employment. Well, now it's practically the day of closing. We are just making certain. We're also implementing in our email templates a notification once a loan goes into processing that if they even think that they're going to be furloughed or their hours cut, they need to notify us immediately, because we don't want them to be at the closing table and we call their employer to find out their hours have been cut. The truth of the matter is a lot of employers aren't saying anything. And so we have found that by implementing this template in our process, it causes the borrower to contact their employer and say, hey, is this going to happen? I'm buying a house. Yeah. And maybe the employer wouldn't normally say anything, but since they know that their employee is buying a house, they let them know, no, you'll be spared, or hey, we are probably looking to cutting the hours back. So these are kind of unexpected things. Not that this didn't go on in the past, because people got laid off in the past, but it's just it's a higher percentage. Of course, when it comes to closing turnaround times, my team and I, we've always, in my company, Cornerstone, we typically do 10-day closes. That's our jam. We're still doing them, but it's not just us that we have to rely on. If I just had to rely on my team to close the 10-day close thing, we could do it. But appraisals are taking a little bit longer. Even if now they're mostly exterior only appraisals.
So they don't even go inside the house anymore?
They don't even go inside the house anymore. They can in certain cases, but basically they're going to be exterior only. That has caused its own challenges, because especially in the refinance boom we've experienced, a lot of borrowers think their homes have appreciated a lot more than maybe what they truly have. And so they feel if the value doesn't come in, that somehow they're shorted if the appraiser didn't make entry. So we've come up with a few challenges, but all in all, I think the appraisals have been coming in relatively fine.
What about, so I know you mentioned that you guys can do things fairly quickly. What about, what we considered before, like a standard 30-day close? Is that still the same? Because I've heard some people say, no, it's got to go back longer, maybe 45 days. And I've heard other people say, no, it's not. Like, what are you guys seeing?
Yeah. Well, I can't speak for the whole industry. I can tell you that prior to the pandemic, industry average for closing is 43 days. My team, we would do 10. Our average is 10 to 12. Currently, we're setting expectation for 3 weeks.
Okay.
We've gone to 3 weeks. I would imagine if it was a VA closing, we would probably require 30 days, or at least set expectation for 30 days. Because anytime you're relinquishing some control, which on a VA, we have a VA appraiser, and so we don't get to communicate. We don't know who they are. They're not placed in our rotation. And they typically have 10 to 12 days to give us an appraisal. So in VA instances, I would say 30 days. But anything else, we're doing within 3 weeks.
Got it. Okay. You mentioned refis, which was on my list of questions. I know the refi market went really crazy about, I think it's a month ago. It's hard for me to tell time anymore. But is it still like that? I mean, is it still a great time for people to refi?
It truly depends. I've always said that it has to make sense to refinance. Obviously, you got to make certain to ask the appropriate questions. I don't like people to just refinance because, everybody's doing it kind of thing. I try to put myself in their situation and think if it's really cost effective. So although I want the business, I don't get paid unless they choose to refinance. I have to ask the appropriate questions that I would ask myself, and whether or not, it's cost effective for me to do so. So one, I definitely want to make certain that they're going to live in the house long enough to recoup the cost. Mm-hmm. Because, I hear the buzzword no cost refi, and that's just not true. No cost, there are costs, okay? They may roll in the cost into the loan and not bring any money to the closing table, but there are costs. So I just want to make certain that the individual is going to live in the house long enough to recoup the cost associated, and then get enough savings through either, their monthly payment rejection or their savings in interest. Refinances, what happened was when the feds lowered the rate to nearly zero, everyone thought that mortgage interest rates were going to go to zero, and so we had to kind of debunk that. And so there was this surge of refinances. What I find now is that people are refinancing. They're probably not refinancing at the same pace that they were about 4 weeks ago. Okay. But people are still looking and inquiring about it. And I still say that if you've got a primary residence or a second home and your interest rates are in the 3s currently, I think you would get a better savings if you would just apply extra to principal every month. If you have a primary residence and your interest rate is in the 4s, or you have an FHA mortgage and want to see if you can go conventional, definitely look into it for sure.
When you say applying extra payments to principal, does that mean, let's say my mortgage payment is $1,000 a month. If I just start writing a check for $1,200 a month, does it automatically go there, or do I have to specifically say, hey, this goes to principal?
You would probably you're going to have to say it on your payment coupon, because I would say that the majority of the time the servicer is going to apply it to principal. But what I tell my clients is that if you're in the habit of paying extra principal every single month, make sure you look at your mortgage statement. I also don't believe in paperless mortgage statements. I know we're all trying to conserve and not use paper. Statement's fine, but even though I'm not a big fan of that either, because I want people to know where they're spending their money, and it's kind of out of sight, out of mind. But if you pay extra to principal every month, I would suggest that you either look at your mortgage statement or get online and make sure they applied the funds appropriately. Sometimes they'll actually put that money into your escrow, or they put it in what's called suspense. It's just an account where they didn't know where to put the money, because you're about humans that are posting payments. They're not robots. So human error. So just check it for sure. Okay.
Well, let me ask, is there anything else that you're getting a lot of questions about, or anything else that has really changed in the last couple of weeks that we haven't talked about yet?
Definitely. So when I talked about a plan B option, I have a lot of clients that are concerned about jumbo financing. Jumbo financing is just a loan that you're borrowing that's over 510,400. 510,400 is the maximum conforming limit or maximum conventional loan limit. And many people are financing more than that, especially in Austin because of prices being so high. So jumbo financing is still around. We will do a jumbo loan up to 1.5 million. We will not do jumbo refinances anymore. So you make sure if you're talking to a lender about refinancing that they're still doing jumbo refinances. Our company no longer does it. There are a few out there that still are. I don't know if they're going to pull that themselves. I can only speak for us. Jumbo financing, we're still doing it. What is happening, jumbo loans are considered higher risk because of the amount that you're borrowing. So just like Fannie Mae and Freddie Mac have tightened up their automated approvals, jumbo financing has tightened up on their reserve requirement, their credit score requirement. So when I say plan B option, the plan B option for most of my clients is jumbo financing. A one-note mortgage typically looks more attractive, but plan B, if jumbos go away completely, I prepare my clients that we're going to do a first and second lien combo. Plan C, what if second lien companies go away? They never have. I say never. They've tightened, and they didn't do maybe 95% CLTV products, but they pretty much always stayed around. But the plan C would be, do you have a gift option? Or is there a way to tap into retirement and get a temporary loan? So we start talking about those things. And then down payment assistance has been a big topic lately.
Yeah.
Our company has suspended down payment assistance program.
Okay.
Just because those loans statistically perform poorly. And of course, in a pandemic, we haven't experienced, but in a downturn of an economy, those are the loans that are going to be slow pays. And so because of that, we have suspended them. We are still doing mortgage credit certificate, MCC, things like that, but we're not using, we used to use that program to help people qualify. We're no longer we're not using that to help people qualify anymore. We're using it as an added bonus or incentive for the consumer to buy. So we're just having to look at things a little bit differently. So the Plan B option for someone that wants to buy but only can purchase with down payment assistance is we're wanting them to have talks with members about a gift option or savings plan.
So down payment assistance, is that usually backed by the mortgage company, or is it backed by the government?
So it's regulated by the city and the county, and these loans, they can be grants from the city or the county. Some of these programs have specific servicers that must service the loan, and because we don't know what's going on with them and when they're going to stop their servicing of these loans, that's why we backed out. The bottom line is that we don't want to qualify someone where everything must align perfectly for them to close, because we don't want to let people down. And because we don't have control of those loan programs, we would rather suspend them on our end, just so that we, again, don't let people down. But the grants that are in addition to, like if you're doing a traditional FHA purchase, but you want to use the city of Austin money, we will still do that. It's just if the financing is contingent upon a certain servicer still servicing these loans. So it's something that the lender is aware of. Also, USDA 100% financing programs, those are still going on. I want to shout out to my team, because traditionally those programs take about 45 days to close, and my team and I, we closed in 10 days last week. So we had a 10-day close on a USDA, which is unheard of. So USDA 100% financing is still around. That program is available for buyers looking in areas that are in the suburbs, or excuse me, the rural areas.
Okay, awesome. Awesome. Well, hey, I think we have taken up a good amount of your time. I really just want to thank you for being frank with everyone, and just telling everybody what it really looks like out there. If anyone wanted to reach out to you directly about any lending kind of questions, where would they catch you?
I would always tell people to reach out to my team, because I've got a great team of support. So if I'm not around, they can help. So team@biglifehomeloangroup.com.
Perfect. Well, thanks so much for joining us today. I'll talk to you soon. All right.
All right. Bye. Thanks.
Bye.